Hello students, today we will be doing the chapter, the second part of business studies, that is, as you can see this, the second part, we are going to start the second part, that is business finance, and the first chapter is financial management. Okay, so we have completed till chapter 8 till controlling, and now we are going to start part B, that is business finance and marketing. And the first two chapter is about business finance, then it's marketing, and lastly it's consumer protection. Okay, so now we are going to deal about the chapter financial management. Okay, clear? Yeah, before starting this chapter financial management, I'll talk about the word finance. Okay, what do you mean by the word business finance? Because this chapter is totally related to the word business finance. Clear? So as you can see, it's written there, money required to carry out business activities is called business finance. So any business you are doing, no matter if it's small business, big business, or medium scale, or any business you are doing, what you require is, the main thing that you require is money. So the money that you require to carry out your business activities is known as business finance. Okay, and finance is required to establish, to run, to modernize, expand, and to diversify your business. Okay, so if you are getting profit out of the business and you're spending that profit nowhere, so what will happen? Your business will be at a loss, your business will end, your business will shut down. So for that, what you need? Your money to expand your business, to diversify your business, to modernize your business. Okay, so the money required to carry out your business activities is called business finance. Clear? And the first chapter, that is chapter number 9, is financial management. Okay, so financial management, as written over there, it's concerned with the proper management of funds and involves decision relating to the efficient acquisition and allocation of funds. Okay, so this chapter is totally, will deal about how to utilize your funds properly, because you get investments, you get funds from many places. A business gets funds from many places. Now you have to decide, you have to manage those funds, where to allocate, what to buy from those funds. So this is all related to financial management. Okay, so financial management is concerned with the proper management of funds, whatever funds you are getting, what you will buy from that funds, where you'll allocate that funds, you'll buy assets, you'll go for acquisition of assets. So it depends on you, depends upon your business, what is required for your business. So this requirement, this decision that you are making is known as financial management. Okay, so there are two objectives, there are basically two objectives of financial management. Number one is profit maximization, and number two is wealth maximization. First profit is profit maximization, second is wealth maximization. You are allocating your funds for the betterment of your business. So what you are doing, why you are doing, for the main motive is profit. And number two is wealth maximization, means acquisition, more and more wealth should be there for your business, more and more assets should be there for your business. Okay, so there are mainly two objectives behind financial management. Number one is profit maximization, and number two is wealth maximization. Clear? Yeah, and there are three major decisions involved in financial management. Three major decisions. You should remember this. Number one is investment decision. Number two is financing decision, and yeah. So number one is investment decision, number two is financing decision, and number three is dividend decision. What are they? I will deal about each and every topic one by one. But first of all, you should know the three names. The three names are investment decision, financing decision, and dividend decision. Okay, now let us see one by one. What are they? Investment decision. The decision is about how much fixed and working capital will be needed to acquire fixed assets and to meet the day-to-day requirements of the funds. So investment decision is all about where will you invest your money. Whatever money you have in your business, there are two options to invest. Number one is long term and number two is short term. Long term, it can be acquisition of assets, land, building, machinery. You are purchasing, you are acquiring assets. Okay, so this will be in the category of long term, because once you are purchasing land and building, you will not sell that land and building within a day or within a year. You will keep that land and building so that the value of that asset rises. So whatever money you have to take decisions that where will I invest this money. And there are two main decisions in investment decision. Number one is long term, for buying of assets, and number two is short term. Short term means for working capital management. And what is working capital? The capital, the money which is required for daily running of the business. Clear? The money which is required for the daily running of the business. Clear? So again, I'm repeating, the decision is about how much fixed and working capital will be needed. One is fixed capital and one is working capital. Fixed capital is required for long-term acquisitions, for assets, for purchasing of fixed assets, and short-term is for working capital, which means for daily running, for daily activities of the business, the money which you require is short-term decision. Clear? Then comes your financing decisions. Decision is about how to raise or procure the necessary capital funds. The main source of funds are shares, debentures, public deposits, loans for financial institutions. Okay, so in investment decision, what you are doing, you are deciding where to invest your money. And in financing decision, what you're doing, you are deciding from where to get the necessary funds, because you alone cannot invest in a business. You need funds from many investors, from many people. So there are two type of investments. One is owner's fund and one is borrowed fund. We'll deal this in the next chapter, but here you should know there are fund can be collected from many sources. Public deposits, loans, shares, debentures, many sources it can be collected from. Okay, so the first is investment decision, and which means where to invest your money. It can be long term and short term. Second is financing decision, which means from where to procure necessary capital, from where you should get the sources of fund, where should you generate the sources of funds. Okay, and at last is your dividend decision. Dividend means a part of profit that you are giving to your shareholders. In this financing decision, there will be many shareholders who will invest in your business. Okay, there will be many shareholders who will invest in your business as owners, and they will become the owners. To those owners, the return that they will get from the profit is known as dividend decision. Okay, the return that you are giving to these shareholders is known as dividend. So it involves deciding how much of net profit of the firm will be distributed as dividend and the extent to which it will be retained in the business to meet the future requirements. Okay, so two decisions you are taking over here. One is dividend, how much dividend you will pay to the shareholders, and how much money you will keep aside for your future requirements. Okay, clear? One is dividend and one is retained earning. Clear? Let's see next. Yeah. Next is financial planning. So did you get this? These three major decisions: investment decisions, financing decision, and thirdly it's your dividend decision. Let me show you from the book. Yeah, see this? The three main decisions are, number one, this is I am following NCERT book. Number one is financial decision. In a financial context, it means the selection of best financing alternative or the best investment alternative. Understood? From where you will get the best finance, either from owner's fund or through borrowed funds. Clear? And then is the investment decision, which we did, which means investment means where will you invest your money. It can be long term and it can be short term as well. Long term means, what did I say about long term? Which means acquiring or acquisition of fixed assets, long term assets. And your short term means your working capital requirement. Clear? Understood? Yeah, and last, here we saw financing decision, which means where will you get the money from? Where will you get the money from? Where will you generate your money for the running of the business? As Business finance means the money required for the daily operations or for running of business activities. Clear? Understood? Okay, let's see next. All these are not there, not so important. Yeah, and last is the dividend decision. And what is dividend decision? Which means dividend, as I said, the return which the shareholders are getting, the return that the shareholders are getting is known as dividend decision. Okay, the return that you are paying them, the return that you are giving them to the shareholders out of the profit is known as dividend decision. And in dividend decision, two main things are important. Number one, how much dividend you will pay to the shareholders, and number two, how much money you will keep aside, you will retain as a part of profit. Clear? Understood? Yeah, so now we will start with financial planning. Let's see what is financial planning. Yeah, so financial planning refers to the process and functions of determining capital requirement of a business and deciding the various sources from which it can be procured. Okay, so financial planning, I'm repeating this again. Financial planning means refers to the process and function of defining the capital requirement of a business. See, a business works with a capital. So how much capital is required? It can be a huge amount of capital, it can be a less amount of capital. So it depends upon various factors which should be kept in mind before deciding the capital of the business. So financial planning is all about that. To determine the capital of the business, to set the capital of the business is known as financial planning. Okay, not much is there in this PPT. Let's go to the book right now. So as you know, financial planning is to determine the capital structure of the business is known as financial planning. Clear? Okay, yeah, importance is there. So let's see the importance as well. What is the importance? Yeah, see the importance. It seeks to eliminate wastes of funds and provide better financial control. So the first important is it is seeking to eliminate waste of fund, which means if any unutilization of resources happening, that is, it is eliminating the unuseful utilization of resources. It is only doing efficient utilization of resources. It takes care of inflow and outflow of cash, which means the cash flow. Whatever cash is coming in, how much cash is going out, it looks for that. It aims at efficient and optimum utilization of surplus funds for the benefit of business. So whatever profit you are getting, it sees that, capital structure sees that, financial management sees that these funds are not getting wasted. It ensures increased profitability through cost benefit analysis and by avoiding wasteful operations. Okay, let's go to the book right now. Yeah, see the capital structure. I'll do this once again. So just I'll do this once again. So as I said, what is financial management? What is financial management? To determine the capital of your business. To determine the capital of your business is all about financial management. And what should be your capital? We'll see this here. Okay. See, as you can see here, capital structure refers to the link between owners and borrowed fund. Okay, capital structure, it's of two types, owners fund and borrowed fund. Okay, capital structure, it's of two types. One is owners fund and one is borrowed fund. Owners fund is known as equity. This is equity. Owners fund is known as equity and borrowed fund is known as debt, which means whatever money you are getting through borrowed funds like from debentures, bank loan, public deposits, it all will go, these all will go to debts. It will be considered as debts. These are simply the liability of the business. And if you are getting finance through owners fund, which means through shares, retained earnings, all these will be considered as equity, which means equity means the owners fund. Okay, now to talk about the capital structure. Capital structure, as I said, it refers to the mix between the owners and the borrowed funds. Okay, I'm repeating this again. Just remember this point, students. Capital structure is made, the capital structure of a business is made of two things. Number one is debt, which means the liability of the business, external liability of the business. Okay. And number two is equity, which means the owner's fund. The money that you are getting, the finance that you are getting through borrowed funds like debentures, public deposits, bank loans. These all will considered as debts, which means loans, which you have to pay. They are simply liability for the business. And number two is owner's fund, which are considered as equity, which means shares, retained earnings, all these are considered as equity. Okay, clear? So the capital structure, it refers to the mix between the owners and the borrowed funds. Okay, this capital structure refers to the mix between the owners and the borrowed. These shall be referred as equity and debt. In the subsequent, it can be calculated as debt by equity ratio. So capital structure defines the ratio between your debt and the equity. Understood? It defines the total of the debt divided by the equity. The ratio between the debt and the equity. Whatever is your debt, which means whatever is your borrowed fund, divided by the equity, whatever is your owner's fund. Okay. Now if I ask you a question, according to you, which should be higher? Debt should be higher or equity should be higher? Your borrowed fund should be higher or your owner's fund should be higher? The answer should be your owner's fund should always be higher. Why? Because risk is more attached with debt. Why? Because no matter what, your business occurs loss or your business is having profit, you have to pay them interest. You have to pay interest to the debenture holders. You have to pay interest to the bank loans, to public deposits. No matter what, you have to pay them. But in equity, they will get return, they will get dividend, the shareholders will get dividend only if the company is having profit. So risk is more with debt. So the company should be sure, while determining the capital structure, the company should see that my debt is always lesser than the equity. See this line? Debt and equity differ significantly in the cost and riskness of the firm. The cost of debt and the riskness is higher. The risk is always high with debt. Why? Because no matter your business earns profit or loss, you have to pay the interest. But for equity, only if you are getting profit, then only you will pay the dividend. Okay. Cost of debt is lower than cost of equity. Here if I talk about the cost, the cost of debt is quite lower. Maybe the interest. Why? Because you have to pay less interest to the bank loan, you have to pay less interest to the debenture holders. The interest rates are always fixed for borrowed funds, for debts. But for equity, the rates are not fixed. They get according to the profit. If the profit is higher, the shareholders will get higher profits, higher returns. If the profit is less, they will get less profit. So the cost is always higher of equity as compared to debts. But if I talk about the risk for debt is quite higher as compared to equity. Why? Because as I said, you have to pay them interest, no matter you are paying them less interest or no matter you are paying them higher interest. If your company is having profit or loss, you have to pay them interest. But for equity, the risk is less. Why? Because if your company is having loss, you don't have to pay them returns, you don't have to pay them dividend. Okay. So if cost is concerned, debt is good. Why? Because cost is less as compared to equity in debt, and where risk is concerned, debt is riskier than the equity. Clear? So this is the capital structure of the business. It defines the ratio between the debt and the equity. Okay. Clear? Okay. So let's see one sum. Let's see one sum. Let's see one sum. So as you can see, this is a company X Limited. This is a company X Limited. Okay. A company is X Limited. Total funds used is 30 lakh. The total fund used is 30 lakh. Total funds used is 30 lakh, which means debt plus equity. Here it means debt plus equity is 30 lakh. Okay. Interest rate is 10% and tax rate is 30%. Interest rate 10% means the debt, the loans that you have taken, that is the interest that you will pay to the loan is 10%. Okay. Earnings before interest and tax is rupees 4 lakh. Earning before interest and tax. Earnings before interest and tax means this earning which you are getting, this is the gross profit. Why? Because you haven't paid your interest and you haven't paid your tax as well. So this is the earning that you are getting 4 lakh, that is before giving interest and before giving tax. Okay. So there are three situations. Situation 1, there is no debt, which means this total 30 lakhs is owner's fund. Total 30 lakh is owner's fund. Okay. Situation 2, the debt is rupees 10 lakh, which means out of this 30 lakh, 10 lakh is borrowed funds and 20 lakh is owner's fund. Okay. And situation 3, debt is 20 lakh, which means 20 lakh is borrowed funds and 10 lakh is owner's fund. Now let us see, we'll go for EBIT and EPS analysis. EBIT means earnings before interest and tax, and EPS means earning per share, which means for each and every share, for each share, how much are you earning? How much profit are you getting for each share? Okay. Let's see this. Earnings before interest and tax for situation 1, 2 and 3 all are same. Situation 1, 2 and 3 all are same. 4 lakh, 4 lakh and 4 lakh. Okay. This is before. This profit is before giving your interest and before giving your tax. Okay. 4 lakh, 4 lakh and 4 lakh. So what will you do first? You will pay your interest. So let us see in situation 1, how much loan have you taken? So in situation 1, what we are seeing, out of 30 lakh, there is no loan. Total 30 lakh is owner's fund. So are we going to pay interest? The answer is no. We will not pay interest. Why? Because full 30 lakh, this full 30 lakh is owner's fund. The company has not taken any loan. For situation 2, the company has taken loan of 10 lakh. So the company will pay interest 10% at the rate 10%. So 10% of 10 lakh is 1 lakh. Okay. The company has taken loan of 10 lakh out of 30 lakh. So the company will pay interest at the rate of 10% on 10 lakh, that is 1 lakh. Okay. And in situation 3, the company has taken loan of 20 lakh. So the company will pay interest at the rate of 10% on 20 lakh, that is 2 lakh. Clear? So your earning before tax. Now this is out of this EBIT, earning before interest and tax, you paid interest. You paid your interest. Now earning before tax, you haven't paid your tax. So this is earning before tax, before paying your tax. That is 4 lakh minus nil. Why nil, as I said? Why? Because the companies will not pay any interest. Why? Because the company has not taken any loan. See, there is no debt. So this is 4 lakh minus nil is 4 lakh. 4 lakh minus 1 lakh is 3 lakh and 4 lakh minus 2 lakh is 2 lakh. Now the company will pay tax, and the tax rate, as you can see, is 30%. Tax rate is 30%. So the profit is 4 lakh, 3 lakh and 2 lakh. So 30% of 4 lakh, the tax will be 1 lakh 20,000. 30% of 3 lakh will be 90,000 and 30% of 2 lakh will be 60,000. So in situation 1, the tax will be 1 lakh 20. In situation 2, the tax will be 90,000, and in situation 3, the tax will be 60,000. So out of 4 lakh, you will pay 1 lakh 20,000 as tax. So your net profit will be 2 lakh 80,000 in situation 1. In situation 2, out of 3 lakh, you will pay 90,000 as your tax. So your net profit or earning after tax, after paying your tax, will be 2 lakh 10,000. And in situation 3, the profit is 2 lakh and you will pay tax of 60,000. So your net profit will be 1 lakh 40,000. Okay. So this is your net profit. This is your earning after tax, your actual profit. This is your actual profit. Okay. So now the number of shares of rupees 10 each. See the number of shares. See here, the number of shares. Here it's written number of shares. It's 3 lakh, 2 lakh and 1 lakh. 3 lakh, 2 lakh and 1 lakh. Okay, number of shares of rupees 10 each. How do you get this? Is rupees 10. In situation 1, what is owner's fund? Owner's fund is rupees 30 lakh. Owner's fund is rupees 30 lakh. Okay, now if I divide by rupees 10. Why rupees 10? Because each share is costing rupees 10. See, it's written over here. Each share is costing rupees 10. Number of shares of rupees 10 each. So each share is costing rupees 10. How much? Rupees 10. Okay. Each share is costing rupees 10. So the total number of share will be 30 lakh divided by 10. 30 lakh divided by 10. So how much share you will get? 3 lakh shares. Okay. How much shares? 3 lakh in situation 1. In situation 2, your owner's fund is 20 lakh. Why? Because 10 lakh you have taken loan. So out of 30 lakh, if 10 lakh is loan, so 20 lakh will be your owner's fund. Okay. So number of shares will be 20 lakh divided by 10. That is 2 lakh. And in situation 3, you have taken 20 lakh as loan, as borrowed fund. So 30 minus 10 is 30 minus 20 is 10 lakh. 10 lakh will be your owner's fund. So 10 lakh divided by 10 is 1 lakh. So in situation 1, the number of shares is 3 lakh. In situation 2, the number of shares is 2 lakh shares. And in situation 3, the number of shares is 1 lakh shares. Okay, clear? So how much are you earning? How much are you earning? Tell me. Tell me how much are you earning? See, for 3 lakh shares, your total earning is 2,80,000. How much? For 3 lakh shares, your total earning is 2,80,000. So for one share, it will be 2,80,000 divided by 3 lakh. I'm repeating this again in situation 1. For 3 lakh shares, your earning is rupees 2,80,000. Okay. So for one share, it will be 2,80,000 divided by 3 lakh. That is 0.93 rupees, 0.93. Here for 2 lakh shares, you are earning rupees 2,10,000. So for one shares, you will earn 2,10,000 divided by 2 lakh. That is 1 rupees and 0.5 paisa. Here for 1 lakh shares, you are earning 1,40,000 rupees, 1,40,000. So for one share, you will earn 1,40,000 divided by 1 lakh. That is rupees 1.40. Okay. So this is your EBIT and EPS analysis, which means earning before interest and tax and earning per share. For each share, how much are you earning? Okay. For each share, how much are you earning? Clear? So this is all about EBIT and EPS, the capital structure. This is mainly your capital structure. Okay. And remember one thing, students, I'll repeat this again. Capital structure should be debt by equity. In debt, cost is less. In equity, cost is higher. In debt, risk is higher. In equity, risk is less. So capital structure is the ratio between the debt and the equity. Okay. Clear? Understood? Okay. So all these are mostly sums. Clear? So just go through this chapter, students. If anything is left, I'll just complete this in the next class. I don't think so anything is left. This is all about the first chapter, the 9th chapter, financial management. Okay. Okay. Thank you, students. God bless.